Well, there'll be plenty of time to continue the discussion over our coffee break. Thank you. Thank you, first panel. We've got about 15 minutes, and then we're going to be really timely because we've got a lot more to discuss in panel 2. Thanks so much.
Well, good late morning to everybody. Thanks again to that last fiery panel. I love all the enthusiasm and questions in the room, so keep that coming. We are switching gears a bit, though. We have a great group of panelists here, and this conversation is really going to focus more on the practical applications of data, both the one that Kazar and Claire have worked so hard on and presented here this morning, and then also ways and other sort of methods and means by which cities and partners in cities access and use data in decision making. I'll just frame it a little bit in the beginning by saying that cities are getting much more sophisticated in how they use data to make decisions, both in designing programs and policy making. And much of the focus, there's been a lot of focus on using evidence and data by a lot of technical assistance providers and funders and others, including my organization, when they work with cities to really focus on improving services, listening to residents, really addressing challenges that exist and try to better understand and describe what's happening in the economic environment in a city before and while programs are being designed and implemented. The thing that's so exciting about the credit model we looked at this morning, which was mentioned a couple of times, but is the unique way that it shows trajectory and not just sort of a snapshot in time. And that's something that, again, is really helpful when cities and organizations are thinking about the future and sort of how to plan for what's coming rather than sort of what's existing or what has happened in the past. There have been a lot of, like some of just the snapshots I noticed from the cities that we've got on the panel. Both Rochester and New York City are sort of on the lower end of the spectrum, but Rochester seems really stuck where it is, whereas New York is showing some signs of improvement. And so as city leadership are thinking about different interventions to address some of those challenges, that kind of information is unique and really valuable. So we're going to dig in a little bit to those types of topics. I'm going to start just with a general question for everybody about how you and your organization have used data to inform policy priorities and to develop programs. And maybe I'll start at the end with you, Nicole.
Hi, good morning, everyone. My name is Nicole Perry. I'm the Deputy Commissioner for the New York City Office of Financial Empowerment at the Department of Consumer and Worker Protection. And our office is focused on improving the financial health of New Yorkers. We are the first local government initiative with the mission to educate, empower, and protect New Yorkers with low incomes. And for us, data has always been a very integral part of our program model or our approach to our work. We use data in a number of ways, including thinking about what areas do we focus on and kind of where do we draw our attention for our programs and services. And I'll step back and say that we use a number of strategies to approach our work. Some of our initiatives that may be more familiar with folks are related to our Financial Empowerment Center initiative, where anyone who lives or works in New York City can get one-on-one financial counseling and coaching for free. And then also our annual tax season initiative, which is focused on free tax preparation services and building awareness around the Earned Income Tax Credit in New York City. In addition to that, we work to increase access to safe and affordable financial products and services. We also focus on consumer protection and fighting predatory and deceptive practices in the marketplace. And we've expanded our work to look at what a number of the panelists talked about is around community wealth building, neighborhood financial health, and how to use inclusive ownership models to help New Yorkers build assets. So with that being said, in terms of how we use data, data informs our programs and services. We also use it for our marketing and outreach efforts. So based on what we learn about different communities and their needs and where we see trends, it allows us to target our outreach efforts in those neighborhoods and communities. We also use it when we're trying to determine the location of our services. So if I think about our financial empowerment centers, those are very strategically located in areas and communities of need or easily accessible areas in New York City, similarly for NYC free tax prep services. And then we also use data to try to identify gaps in our services. So for instance, a couple of years ago, we did an initiative specifically focused on customizing our financial counseling and coaching work for New York City public housing residents because we felt through our general channels, such as the Financial Empowerment Center, we weren't reaching that population as we thought we should have. It's also connected to a launch. Similarly, we launched an initiative with City Community Development and the Mayor's Office for People with Disabilities called Empowered NYC, where again, when we looked at the financial challenges and struggles of people with disabilities and their families, we realized there was more that we could be doing to serve that population. And so using that data and then starting the process of community engagement, we were able to develop and target our services to better align with what we were seeing.
Great, and could you maybe give a couple of examples of other, I know that you and your programs collect a lot of data on your own clients, but what are the other sources that you turn to sort of out there to inform some of the work that you're doing, and what resources have you found useful at the city or community level?
Sure. One of the things that's really important to us at the Office of Financial Empowerment is making sure that we have data at the New York City level and even at the neighborhood level. And I think from a data and research perspective, in many ways, that's a huge contribution that we're able to make to the space, and it informs, again, a lot of our work. For us, I think we'll talk more about our collaboration with the Federal Reserve Bank of New York is one example in terms of looking at student loan debt outcomes in New York City and in New York City neighborhoods. So where we don't necessarily have the data, we're able to collaborate with other organizations to try to drill down into the data at a New York City level. So the collaboration with the Federal Reserve Bank of New York on student loan data is one example. We've worked with the Urban Institute in terms of publishing reports on the unbanked and the underbanked in New York City, understanding the perceptions of financial health of New York City residents, and replicating a number of national level studies and bring that information to the New York City level. So we definitely rely a lot on collaboration with other research-based organizations to kind of get that New York City level perspective.
Great. And Haiti, do you want to talk a bit about how you use data to inform your programs?
Good morning, everyone. And thank you for the New York Federal Reserve for bringing together practitioners, nonprofits, and very much in the trend of data and data-driven programs overall. And I'm tremendously excited to be on this panel, worked with many of you for years, and you're doing amazing work in terms of data and bringing these services to populations who desperately need the services overall. I work for the Financial Clinic. We're a 14-year-old organization. Our mission is building financial security, and we help change the everyday of families and organizations. For families, we help them identify financial goals and build better household balance sheets through financial coaching. And for partners, if you are interested or think that there's a connection between getting program participants to get a job, to go to college, or to move into permanent housing, and that those connections are improving credit profiles, reducing debt, increasing savings, we'll help give you the tools overall to do that. Now, in terms of data, I think pertinent to this conversation is that the Financial Clinic has a social enterprise called Change Machine. It is a Salesforce-based online financial coaching platform that combines tools and resources to help support the coaching process. For about, to date, since we launched in 2015, 3,800 practitioners across the country, and that's about 72,000 individuals have been inputted into the platform overall. Now, I think in this room, 72,000 is a drop in the bucket to the data sets that many of you are dealing with, but it does give us a picture of financial security across the country overall. And so that combination of quantitative from our platform and the qualitative of what the coaches on the ground and our practitioners and partners give us a very rich set of information to think about program design. And maybe I'll just highlight one or two examples from 2019 and how we use the data to inform program design. I think student loans was actually one of the the highlight topics of the first panel. And we had done a project in North Carolina with Durham Tech Community College in this integration technique. How can we serve students better with just general financial coaching? How are we improving their credit profiles? How are we looking at, how are they helping with debt, paying for daycare while they're in school? And as we concluded the project, we were left with, as all programs are, where do we take this? How do we evolve the model going forward? And two things kind of happened at the same time. The first was we read a report from the Center for Responsible Lending on 1.2 million North Carolinians are struggling with $44 billion in student loan debt. And that is, as many people have pointed out in this room, a game-stopping kind of debt now because of its consequences to home ownership, its consequences to going to school, and to really like build that pathway to prosperity. And so we looked at our own data. Student loans were certainly prevalent for the non-traditional students that were going to community college. And then we looked at the resources in the community. And what we are struck with, as I think many individuals in this room are, is that student loan does not have that infrastructure of addressing it that some of the other types of debt have, whether it's consumer debt or you can see in legal services across the country, they tend to be in different buckets and not so much student loans. So when we went back to the funder, what we said is taking the data that's been done by excellent researchers, knowing what our data is, and kind of understanding the community that we're serving, what would be a good pilot to try? So working again with Durham Tech Community College, what if we look at 600 students, those who are identified as, who can work with the community college, they can give us data on who's late on their payments, who has the presence of student loan debt, and what can we better understand about how they are making that work with school, with work, with their families overall. So in some ways that helps us determine where do we want to position our services going forward. And then what we often do with our projects, especially our service ones, is to have milestone early insight analyses. So after the first 500 participants, we take the baseline demographic and household balance sheet information, and we see where is it different than the aggregate profile we might have in our financial coaching platform. What are the differences? What are the unique things that might happen for, a recent one is youth workforce in New York City. How did their expenses differ from again, that aggregate profile? And we try to dig deep into it. And I'm sure as we go on, we can talk about some of the specifics about how you change your programs, what interventions might you try to pilot based on sometimes that early analysis.
Great, thank you. Ruhi, you have bring a slightly different perspective to this.
So I'm Ruhi Maker, and I'm an attorney at the Empire Justice Center in Rochester, New York. And I started work as a housing lawyer representing low-income tenants, and soon realized that there essentially wasn't enough housing money in this country to have safe and affordable housing for all the people who were rent burdened, and this is going back to 1989. And moved on, continued to be a housing lawyer representing tenants, but moved on to doing CRA work, and along with a number of folks in Rochester, we started the Greater Rochester Community Reinvestment Coalition. And one of the very first things we did is we looked at home mortgage lending data, and we looked at it at the census tract level, and we looked at data in middle-income African-American neighborhoods and low-income white neighborhoods. And as was referenced earlier, if you were a low-income white person in 1992, 93, living in Rochester, you were 4 times more likely to get a mortgage loan as a middle-income black African-American person. And since then, we have 30 years of data and 30 years of maps, and we meet with the financial institutions. We've commented on virtually all the mergers of financial institutions that are in this city, but also in Rochester, and we've essentially gone to the financial institutions, and when they say, we did $50 million worth of lending, we point out the $50 million of lending they've stopped doing, and also analyzing exactly where they are and aren't lending. So I'm going to kind of fast forward to work we've done with the Federal Reserve. I mean, I've had a relationship with them for 20, 30 years now, it seems. Essentially, the first lot of community credit profile that Kosser and Claire and her team did was to look at subprime data, and they looked at it at the county level. And they came to Rochester, and we had a big presentation. And the numbers at the county level were not bad. I mean, they didn't look as bad as they were. So this is a few years ago, while we're still kind of out of the recession, but just barely out of the recession. And we sort of said, we want this data at the block group level, or we want it at the census tract level, because again, I've also been a foreclosure lawyer, and I know that you can have a white suburban town doing in crisis with some foreclosures, but you again have the foreclosures concentrated, 6, 10 to a street, to a block, and we were able to show how that was going to play out with essentially devastated neighborhoods, again, communities of color, African American and Latinx communities. So when they did their analysis at the zip code level, because of hypersegregation, we were essentially able to show that the most impacted neighborhoods, which were majority non-white, had 50 to 75% of the population was subprime. When we started meeting with the banks, we were, all your products are only aimed at prime people, and you've essentially ceded the ground of subprime lending to predators who extract wealth and give you loans that make the person with the subprime score fail. I mean, that's what happened with predatory lending. People had good fixed term CRA loans, and they were targeted, and whatever equity they had built was extracted from those neighborhoods. And those neighborhoods were, again, communities of color. So we started talking to the banks. We then analyzed bank accounts. We said, let's just look at bank accounts and see who's got what. And we essentially were able to show that the only way you could have a bank account and not end up overdrawing and look at all this research to figure out whether or not you should or shouldn't overdraw. The only way you could not overdraw was to have money. I mean, I spent a lot of time looking at all the rules of overdraft, and I'm a consumer lawyer, and I was like, there's absolutely no way to figure this out. And so we then did like what I would call a mini test, and essentially we sent someone to a bank, and it was, well, the only way this person who is living paycheck to paycheck can not overdraw is to have money in their savings account. So when they, when the credit comes through and the debits come through, and the debits are ordered in a way that is meant to extract wealth and to extract fees, the savings account will come in and essentially save the person. In another situation, they had what's called a bank on account, and the person who walked in wasn't offered it. So we've, realizing the extent of subprime, and that was kind of interesting. I mean, I've been working in Rochester for 30 years. I've been a public interest lawyer, and the subprime data was actually worse than my wildest imaginations. So, fast forward to that, Center for Financial Empowerment flew into Rochester, October of 2018, and I serve on the team, the advisory committee, and they came in, they looked at our report, and very quickly we started the mayor and her staff who are here, one of whom is here today, put together a program, and we hope, fingers crossed, that a Center for Financial Empowerment will open next year, in January. So essentially you've got the Fed data at the zip code level, showing the problems with communities of color, showing that we need to figure out we need to make sure that people who are living paycheck to paycheck know how to avoid all the pitfalls, all the traps. I think of it as snakes and ladders. We have an economic system where we have ladders, and I've been here, I wasn't born here, but I've been working with communities of color and low-income people for 30 plus years. We've taken away the rungs, and all there are snakes. And if you're superhuman and you can jump those 4 rungs and get to the top, and then the next product you buy is going to bring you all the way down, and then the snakes, it's like we have set it up so that working families who are making $15 or even $25 an hour cannot succeed. I mean, it's what was said in the earlier panel, that if you're poor, we'll make sure that the very little money that you have, the $300-400 that you could save maybe a month, we'll make sure we extract that from you. We'll whether with whatever product you're going to go into, whether it's a bank account, and so that's where we are. We aren't. I used to think when I first started doing access to credit work that we could create products and we could essentially financially counsel people to become homeowners. Now, Rochester, when I started doing this, someone making $25,000 a year, a home health aide working at the University of Rochester, we could turn her into a homeowner even if she had a child. Now, you're $50,000 a year, student loan debt, credit wrecked, all of the things that you did, you're essentially, it's like, the only way you are able to access wealth is your parents paid for you to go to college or paid your tuition and/or are willing to give you a down payment. And for me, we need to change the system that's, given that we've been extracting wealth for hundreds of years from communities of color, that we have a system that is fair and that brings people up. And so, and I've got a very specific data ask that I'm going to talk about, but I'm going to stop there. But I do want to really, Kausar and her team, the data, I mean, I've been working with them for 30 years, and to talk about all the data conversations and all the work we've done with the Fed would take up all of the rest of the day. But literally the data that they have done for us in Rochester and in New York has impacted tens of thousands of lives, and has preserved home ownership for New Yorkers because of the foreclosure data they gave us, and this new data set that they, on subprime is creating, having the Center for Financial Empowerment. And I think the professor who was here has left, but I mean, it's just crazy that I should be an optimist after being a public interest lawyer for 40 years, but I am an optimist. When I started and I talked about my clients, they looked at me with my accent and my non-Anglo name, and this is at the Fed, and I will not name which Fed building I was in. It wasn't this building. And they basically looked at me and they were like, she's only here because of the color of her skin. And they just couldn't hear what I was saying. And I was talking about the subprime crisis and the recession that was going to come to us, and I was doing that in 2002. And as were other consumer advocates, some of whom are in this room. And now I'm sitting on this panel, and when I ask Kausar for data, and when I ask Claire for data, and the team for data, they're like, yes, we'll give it to you. And then when they give it to us, and then there are all these things we can do. And so I am going to, I realize I'll probably be doing this as I take my last breath on hospice. But we will take this country back. We will not, it is not acceptable that children in Rochester are going hungry because we are extracting wealth from their parents, who are working families, who are doing everything they can. And that is absolutely unacceptable. And we will change that. Or my children will.
So I hope they've all convinced you how much data is a hallmark of each of their organizations and what they live and breathe every day. But we're living in a data-rich time. We've got all these wonderful resources. We're all collecting a ton of useful information, but we don't know everything. And so my next question is about how, maybe give an example of how you go and find an answer that you're looking for. Like where have you run up against a gap in knowledge that's really critical? I think I cut it out there. That's really critical into decision making, and how have you kind of either scrapped together resources or gone out and made a partnership like the example you just gave with the Fed? Where do you turn when there's a gap in knowledge that you're looking to fill? Maybe start with Haiti.
Oh, yeah. Go ahead, Nicole. Oh, Haiti, sorry.
Let's start with Haiti.
Yeah, I mean, I think you approach data with real humility. You know what you know, but you need resources to help with the context within to data overall. I recently heard a phrase that data is the new oil. And I think that that analogy works on two levels. So the first is, of course, data is, it can be a source of profit. It can be, I don't even know what big data is, but I know I'm supposed to want it kind of thing. But I think on the second level, we don't actually just extract oil out of rocks and then put them into cars, right? We actually have a processing, a refinery system to do it. And so data, in some ways, to move it from data that's static to that which is more insightful, does require the resources of an organization, both what it knows and what it doesn't know, and to reach out to experts in the field. An example of this is we are working with several youth workforce partners in New York City. And again, when I spoke about that early cut analysis, we usually, at a certain milestone of customers, we look at what the data is telling us. And one of the things, we had two kind of surprise moments. I think Jonathan referred to them in his first panel. The first was a higher than average number of these youth who were saying independent housing was their number one financial goal. And we took it and we thought, yeah, who wants mom looking at how many YouTube videos and yelling about like laundry. But when we actually took it back to the partners, what they gave us was some deeper level insights. More about how the household thinks about that sudden increase in income and its interplay with asset limits, and the continued eligibility of the very benefits that keep that household afloat. And so while we can talk about the asset limits in terms of like, can we raise it to 15,000, as Signa Mary kind of referenced in Michigan, what's really important is also understand what are the perceptions about some of these rules and how they influence decision making for the households, and even for the 18-year-olds who we can't presume can live independently even if they want to overall. The second way we were thinking about it was, what we were looking at was double the amount of transportation costs for youth workforce. And one thing to note is that they actually get subsidized Metro cards here in New York City. So they technically might have had zero actual additional costs. And so when we looked into it, what we did is we pulled in some focus groups, brought on some transportation experts. And one of the things they started to signal was the prevalence of shared car service, of course, which is ubiquitous here in New York City. But it is a particular type of shared car service which generated a lot of interest at the organization and for our partners. It was that the pricing model for shared car services, when you look at the ones that are standalone, they more function as private car service. They're only $1 or $2 more than the ones that are, you can get multiple different individuals in the same car. And so what that almost meant was that change of like thinking of public transportation as the means of getting places, when you could almost feel, even at lower income households, that you could almost have a private car service available, and that would facilitate like your ability to go out. It would be able to do many more things, and those pricing models make a difference in how consumers interact and what are the goods that are available out there. And those are the types of things where, when you bring together individuals who can look at the data on multiple levels, and you're bringing different stakeholders to the room, you can begin to really move it from data to insights. Now, to be determined at the end of it if we're going to discard that particular kind of road, but it's something interesting, and I think nonprofits are increasingly getting into the fray of asking themselves different questions about data overall.
Great, Nicole.
So I'll use the example of our work around student loan debt just to talk about or to highlight 3 different ways we've tried to account for or work around gaps in the data. So the first I've already mentioned around student loan debt. Nationally, you've heard the statistics. There's a student loan debt crisis. It's $1.5 trillion in outstanding student loan debt. And then you have the question of what does that mean for New York City? And what does that look like? And so using collaborations, such as the one with the Federal Reserve Bank of New York, we were able to get a better picture of what was happening in New York City around student loan debt. learning that there's $35 billion in outstanding student loan debt at the time of our research, and there were 1 million adult New Yorkers who had student loan debt outstanding. And then starting to think about, as we dug into that data and looking at it at a neighborhood level, really seeing those, what we've been talking about this morning, the kind of disparities in the data and the trends around the data. So seeing that in lower income communities and neighborhoods in New York City, the delinquency and default rates were much higher than in higher income communities. And then seeing that trend where you saw neighborhoods like the Bronx or boroughs like the Bronx in New York City having higher delinquency and default rates. So first, just collaborations. Another example of a collaboration that we've done around student loan debt is looking at research studies, existing research studies that are happening that focus on New York City residents, and seeing if there's a way that we can insert some questions into that data to try to gather information and insights based on already existing surveys and data points that are happening. But the first way is through the collaborations. A second way that we've tried to address gaps in the data is around, I won't call it improvising, but using the available data and trying to, based on the data that is available, kind of see what those connections are. So an example would be with the student loan debt data, we were looking at, used a credit panel and had neighborhood level data. What we didn't have access to for our purposes was individual level data. And so when we wanted to look at the connections to different demographic factors and understand, what was the income of the individuals who were dealing with student loan debt, we actually had to look at median income at a neighborhood level and kind of make those connections and comparisons. So trying to use the data that is available, pulling on multiple resources to start to try to draw some connections. But I think we'll come back to one of, a gap is the individual level story, which is actually the third point I would make. It's actually speaking to individuals, speaking to people, speaking to the community members, doing community engagement. For our work around student loan debt, as we got some of that initial data, we also followed that up with a second report on student loan debt, looking at what are some of the factors that make New York City residents more vulnerable to student loan debt distress. We also went out into the community and we did a public hearing to hear from practitioners, from student loan debt borrowers, from advocates, from a broad group of folks to understand what was their experience with student loan debt, what was some of the pain points, what do they think would be helpful for them to kind of better manage their student loan debt, what was some information that's been confusing and that if they had known differently, they would have made a different decision or it would have been helpful. And then we also just went out to different communities, again, using the data, where are we seeing the highest levels of student loan debt distress, working with our community-based partners and meeting with people in the community and having these kind of sessions where they were sharing with us their experience. And I think it's just really important to get that individual perspective and understand what's really driving the data and what those individual stories are that are connected with the data.
Great, and that's sort of a good segue to what we wanted to talk about next, which is, you've got, again, all these numbers on the page, but how do you really make sense of them and bring them into context, particularly when you're dealing with actual people on the ground, and those are some good examples. I wonder, Haiti, if you want to talk a little bit too about how you've included participant voices and community voices in interpreting what you're learning from Change Machine.
Yeah, it's so critical to really lift up the voices of those that we're serving and the nonprofits that are serving them. People forget that 1 in 10 jobs are in nonprofits across this country. We estimate about 2 million frontline service providers. And nonprofit salaries being what they are, they often face many of the financial insecurities that the people that they're serving are actually facing as well. And so getting their perspective on what is it like to be managing your finances in today's financial landscape is incredibly important. I have the benefit of actually sitting in a financial coaching session not very long ago, a few weeks ago. And one of the to-dos at the top of the meeting, good coaches always say what they're going to do over the next hour, was understanding Venmo. Now, Venmo is, and the coached participant there was someone who English was not their first language. One of their largest discretionary expenses was the fees or contributions to the church. And it turned out that Venmo was one of the ways in which you could now make those contributions. Now, if you think about it, and one of the things that was super interesting was that as they were learning how to set up the app and how to link the bank account and all of those things, he made this very sideway comment that he had just learned how to swipe his card, because there was also a kiosk at the back of the church that allowed you to also make contributions as well. Now, of course, this is partially because contributions are a tax benefit, so everyone's looking to record things. But even more importantly, think about 20 years ago, how did you make contributions? Probably cash, maybe check. Fast forward to the end of 2019, you can still do it that way, but now you have these two other systems that for those who are not necessarily technologically proficient or comfortable with doing it that way, and not necessarily incentivized by the tax system to make their contribution, to provide a tax keeping record, how we interact with modern finances. It is far more complex. We manage maybe upwards of 20 products just to get through our day. It is no longer a cash society. It's increasingly not a cash society, actually. And that's something that the clinic is particularly interested in New York City. So I hope I answered your question.
Yeah, no, that's interesting. And maybe Ruhu too, if you could talk a little bit about the community engagement and how you're sort of collecting information.
As I said, I and Barb Van Kerkhove, who does actually all our data research, we co-convene the Greater Rochester Community Reinvestment Coalition. And while we do data, like we'll sit down, I think the last time the New York Fed was in town, it was on a bank exam, but we start with the coalition, and the coalition is talking about what's actually happening in the neighborhoods. So we have coalition members who are neighborhood-based, and then we have coalition members who do financial counseling or home mortgage assistance, and we get very detailed into here's the mortgage, and here's how you're looking at, for example, student loan debt, because there's a particular way of looking at student loan debt, which means people basically do not get the mortgage because of how the calculations are made. So we go into that. Vacant and abandoned properties. We've got a new land bank that's just a new member. We've got gardens that we're making. So it's very, I think it's really, really important that you don't just sit there talking about data, but you say what's actually happening on the ground. The newest conversation I had is around tiny houses. We're going to figure out and teach those folks who want to build half a dozen tiny houses to, connect with the banks and things like that. So, so what's interesting, what's emerged in the last 5 years is, we've been, let's stabilize people into home ownership. Let's get them out of unaffordable, unsafe housing where they're renting and paying way too much for rent, where they can't be in the better neighborhoods with the better schools, even within the city. And let's try and get them stabilized. And the thing that's coming up is predatory, abusive auto loans. Mm-hmm. And what's coming up, in particular, Melissa Marquez was the original co-convener of the coalition with me, and she runs the CDFI. And the thing that is driving us crazy is that as our members come in, they have these abusive auto loans, but perhaps much, much more importantly, a white subprime borrower with, say, a 550 credit score is borrowing at 12, 13, 14% when the loan to value and the debt to income are the same. And then when you look at the black borrower and the Latinx borrower, they're essentially paying 18, 19, 20, up to 24.99%. and they are being trapped into one abusive product after another. The car, of course, isn't working before the loan is over, so they refinance the unpaid balance. They refinance the unpaid balance. I mean, that's what fueled the subprime crisis, the predatory lending crisis with housing. People couldn't afford to live on their incomes, and they just kept getting inflated appraisals, and they got their incomes lied about, and that's how we kept fueling it. Now, what's going to eventually happen? Are we going to have 1 million cars repossessed in the space of 2 or 3 months before the legislator and the regulators pay attention to it? I mean, student loan, we are actually doing a study on student loans, so I won't touch on that, we're doing a report. But so in terms of, so now every meeting we go in and I say auto loans, and everyone has a story, which wasn't the case 10, 15 years ago, because these abuses were happening even then, but now they're just, so where are we gonna go with the data? I mean, I'm like, the credit acceptance score has 25,000 liens over 10 years in New York alone, right? So originally I was going to say, here's the data ask I want. Now I'm like, we know enough from what's going on that the regulators need to add and the electeds need to add. But if you want the data ask, I want to know at the zip code level who's got subprime and what do the auto loans look like, what's the delinquent look like. Because remember, hyper-segregation, whether we're talking New York City, whether we're talking upstate, and we can essentially see what's going on with auto loans and what's the magnitude of the problem. Like, I know bad things are happening to people because every time I talk to someone about it, I get a story. It's like when household beneficial was first, predating people. I was talking about it, I was seeing clients, I was helping people get fixed. But eventually, everyone had a household beneficial story, right? I mean, and then countrywide and you name it, et cetera. Now everyone has an auto loan story. I think it's very pervasive, but if, the regulators need a dimension, and because what Melissa is telling me is when she looks at investors who own 15% of their portfolio is, bad, C, D, E paper, those, she is convinced that all of those, like the mortgage-backed securities, auto-backed securities, ABSs are going to go south. Now, everyone understands MBS going south, it was much bigger. It's not quite the same because you can repossess the car, you can sell it again, you can refinance it again. And yes, our clients are being destroyed. But, it's like, I want to figure this out tomorrow, okay, maybe January 2020. And I want to stop it by June of 2020. I mean, I am so sick of predatory auto loans, and I'm so mad about it, and I'm so mad about what it's doing to my communities, and not, our communities, that I just feel like it's just grabbing wealth. Now, I know it's not as big of an issue in New York City because, you have the subway. In Rochester, they don't build affordable housing where the jobs are. They don't have public transport that works for you and your children to pick them up and drop them off. I think someone talked about that. And you essentially, you get your schedule 2 days before, and even then it changes. And the only way you have a job is to have a used car, which you're paying a ridiculous amount of money for. So I'm going to get off my soapbox there. But I want an answer on the data before Christmas.
All right. So I have a question that I didn't prep you all on, so I apologize for that. And at the risk of sounding a little subversive at an event all about data, 2 sort of anecdotes kind of came to mind for me this morning when the earlier discussion about the maps and how all the maps look the same. I was in a city recently sitting through a really interesting data presentation where they were showing map after map. And at the end of the presentation, there was some frustration in the room, and someone said, I'm sick of looking at maps about how poor my city is. Mm-hmm. What do I do about this? Mm-hmm. On the other hand, there's another city example of someone who we're currently working with who feels sort of paralyzed by not knowing enough and can't sort of get to decision making because there's always something else. Well, actually, we also just need to figure out this thing, and how do we kind of get every possible question answered before we start? And so those are kind of 2 different problems, but I guess the subject that came to mind was the limitations of data and sort of how you've faced that or dealt with that. And again, I didn't prep you for that, so apologies. But I think it's sort of interesting in this, again, in being in a moment where we're awash in information, where does it sort of stop being useful or potentially set up some sort of hurdle to moving forward?
I mean, I know exactly what we need to do.
I've known it for 20 years. I've been saying it for 20 years in New York City and other places.
So the first thing is, so when I first started, you could move things around and someone making $15 an hour wasn't living paycheck to paycheck. Mm-hmm. Now you're at $25 an hour, $30, $40 an hour. So the first thing is Alice. I mean, you need, we have a living wage in our city, but that doesn't apply to everyone. You have to raise incomes. You have to change the tax structure so that housing, childcare, education, and health are a human right. And you have to subsidize it at ways that are affordable, and you essentially have to have people, we cannot have millions of people not having enough to pay for, basic necessities. You've got to earn enough to pay for those things, and I've got some really rude things to say, but I'm not going to say them because I'm at the Fed, because I'm really angry. I'll be really honest. I'm blind with rage about what we're doing to our moms and our children. It just makes me so angry. That's like what keeps me awake at night. That's like when I was a housing lawyer, it was always about stabilizing the children, about stabilizing housing. They are our resource. And the thing that's going to change, what I'm hopeful is more and more brown and black children are going to end up the majority and paying our taxes and paying our Medicare. And I honestly feel that not just that we have people of color in positions of power in elected, who are elected officials who get this, And that's what with predatory lending, I'm just going to be really blunt. I used to go to DC. I mean, I've been trying to get predatory lending legislation passed in the 90s. I used to go to DC. I'd talk to the black staffers. I would talk about household and beneficial. They all had family members who'd had their equity stolen. And I would talk to similarly the white electeds and the white staffers, and they would just say it's not systemic. And it's like right now, I believe auto lending is systemic. I believe student loan. I think that the people who can least afford it, we set it up to steal from them. It's theft. It's predatory capital, and we've got to shut it down. And I'm in the heart of predatory capital, and I want to shut it down. And that's what I'm going to do, and that's what we are going to do.
Do either of you have thoughts on it?
I mean, I would just add, I appreciate your passion about this because I think a lot of, as we start to do more research and put more data out there, one of the things that we've been calling it research advocacy, and to get people really things need to change. We want people to get excited and passionate and upset about what the data is showing. And I think to the point that you were making, Amelia, part of the risk is that you look at the data, you see it, and I hope that people don't start to become numb to the data, or you see the same neighborhoods, you see the same communities that are struggling, and instead of saying, we need to do something different, what are we going to do? Why do we still see those same trends? We kind of resign ourselves to this is just the way it is, or maybe there's something, there is no solution. And that is concerning. And so I appreciate the passion and the excitement, because I hope more people, when they see the inequities in our society and what the data is showing, that it is something that really kind of motivates us to want to do something and to do something differently. So thank you for that. But I would just say also, data is a tool, and as we talked about, whether it's data or the human perspective, we're trying to, again, appeal to different audiences to say, like, how can we come together and take some type of action? And so I think it's just using that, depending on who you're talking to, using whether it's data, the human element, but making sure we're very just careful in how we're bringing to light a lot of the challenges and being very deliberate about it, because I think it's important. There's so much more that can be done. I think for our office, the Office of Financial Empowerment, we try to leverage the tools that we have at our disposal, really focusing a lot on financial counseling and coaching, but also wanting to look at and address some of the systemic issues that people are facing, because we know it's not just an action an individual can take all of the time to see their situation change. But there's the individual empowerment, and then there's also the systemic and structural issues that need to be addressed. So trying to tackle the issue from both angles. And I think it's really important to collaborate with our sister agencies who folks talked about neighborhood financial health and just all of the different systems and structures that impact an individual's financial health. And it's, housing, it's financial services, it's quality jobs. It's all interrelated. And so we just really have to come together and kind of multi-stakeholders to try to address and come up with solutions.
Right, I want to make sure there's ample time for audience questions, so maybe we can start. I'd like to take a couple at a time, if that's okay. So maybe see two over there.
Is this working? Hello? Okay. Make it quick. We're going to do 2 or 3 together.
I want to address Ruhi. Ruhi, the real problem in the United States, let me go to it, is we used to be an industrial giant, 1896 all the way up. We were the world leader in make manufacture. Today, we're at 48% manufacturing and 52% service, whereas we should be at 80% make manufacture and 20% service. The reason we're seeing all these hiccups that you guys are absolutely right about, especially with Rochester, Pittsford, and Greece, is that we don't have any of the manufacturing jobs here. The Chinese are selling jobs at an hourly wage of 57 cents per hour to our $15 an hour. But we're not making anything, and we keep legislating more trade deals in favor of the latter. New trade agreement with China, where they make more than us, but bringing more Asians into the United States. Where our real problem is when are we going to make the product and say, look, flat out embargo, you're barreling 800 million people in your middle class at us at 57 cents an hour. Our entire nation is 326 million. We're not tackling the right issue. The right issue we need to tackle on data is manufacturing and the college. We have a 529 plan that the poorest Alice can say, look, I got to put $25 a month away for head. Oh, my bad. That's the problem.
Okay.
Thank you.
Next.
Just a quick question, and Ruhi, I appreciate your optimism and also your call to action about predatory lending, specifically regarding auto loans. My question is, given the underutilization of cars, they sit unused for 95% of their working hours. What conversation is happening with like the Ubers, the Lyfts, the GMs, the Fords on car share to make transportation more accessible? Or are you aware of any conversations to make sure that transportation is much more accessible and that maybe people don't have to buy a car despite the fact that they live in, not New York City?
I'm not sure how it works.
Hold on, let's take one more question.
Sorry.
Okay, here you go.
Thanks. Hi, my name is Mark Navarro. I'm with the Robert Wood Johnson Foundation. Thanks for the presentation. Actually, my question was about, we've been talking a lot about banks and their responsibilities as well, but are there examples of the other anchors sort of stepping up, either to inform data or to be informed by your data? Hospitals, for example, universities, are they a part of the mix in terms of places of opportunity or for employment or for advancement? Are they part of the mix of these cross-sector collaborations I think you all been sort of referring to? I'm curious about that.
And just to add to that, as research partners too, and providers of data, that's a good question. Did you want to answer the?
Actually we just had a health report released in Rochester showing disparities purely by race, 10 years of life lost, and the chairperson of that public, it's a health system, Finger Lakes Health System Agency, is actually works at the University of Rochester, and there was, I think your organization has done some research. I just sent some information about the whole health using the university and the hospital, and we have a new precedent. There are people who are involved in that community. My husband actually teaches at the University of Rochester, and I'm really, really hopeful that it can be an engine for change, because it hasn't been an engine for change the entire time I've lived in Rochester. But we have a new precedent, and when I first came, students were told not to walk across the bridge to the black neighborhood, and that's so there. I think the reason I'm hopeful is, so we have an enormous amount of structural racism in this country. And one of the big things that has to happen is that white people who are committed to change have to be willing to do uncomfortable work around structural racism, around having people like me who are really, I'm very in your face, on their boards and in their leadership, and challenging and being willing to look not just, okay, Ku Klux Klan out there, but the structural racism of so many people in New York, in all of New York. And I work with the banks, and I've made a lot of progress. I'll be honest with you. I've had a CEO basically say, you can't lend to black people because every loan you make to a black person will go bad. I mean, literally, obviously he didn't say it like that, but and that same financial institution is really changed dramatically in 20 years. We've been at them and commenting on the exams, and not so long ago I asked their CRA officer, said, how are you now lending? Are you going to keep lending given the new regulatory environment? And he said, we can make money making loans, safe, affordable loans to Black and Latinx people. And in upstate New York, 15 years ago, bankers thought all loans to Black and Latinx people would go bad. I mean, a lot of bankers thought that. So that's changed, and that is changing. And I am going to, be sitting there. There's another exam coming up. The folks from the Fed are there, and we sit there for 5 hours looking at my data. What we need to do is fail all the financial institutions that are not serving low income and communities of color. And so, that's what we need to do, and that's what I've been asking for 30 years. I know I'm not going to get that, but if you've got 75% of your city being subprime, and you don't have a single subprime product, and you absolutely refuse to have even a basic banking account, I'm not going to name the institutions who are like that. Their headquarters are within walking distance. They should be failed, and we should pull all our deposits, our city deposits, our New York deposits. I mean, but that takes a lot of work. Okay, I'm probably disturbing people.
Do you have thoughts on the university, like partnerships with universities? I know you both have been working with community college to some extent.
Yeah, I mean, I think that they are a critical, as college becomes more of a necessity for the future of work, and I'd like to answer some of your question about that future of work. Your educational institutions, some of the, again, nonprofits, I could think this is the theme of my particular talk, they are critical pillars of the community. They are resources. I think as we look at other institutions like churches, they can provide a stabilizing force as change is happening. Can I answer the question about the future of work as well, or take a stab at it? I think what you're raising is one critical trend with the labor workforce, and I think in our youth workforce programming that we've started to do is not so much how do we bring the past back, which is some of the old percentages of manufacturing, but what is the reality in the future of work going forward for someone who is 18 years old, 20 years old? So college is part of that answer, and student loans is part of the problem with that answer. But the reality is that with the smaller percentage of manufacturing, service, and clerical jobs, we are expecting youth today to think about 5 to 7 career changes. And with that is a different skill set. It is the ability to now save not just for college, but that certification in 10 years, that additional skill set in 20 years. How are we thinking holistically about how people are going to engage in the labor force, whether or not it's portable 401ks or other issues that are really secondary to your question about it is changing, but how do we meet those changes, I think is an important one.
Great. All right, well, join me in thanking our panel.